Okay, good morning and welcome everyone to today's webinar, Growing Your Net Worth, Top Strategies and Opportunities for Early Career Stage Professionals. I'd like to quickly introduce two of our presenters who will be talking a little bit more about their expertise, but we have today for you Jordan Egert, a Senior Manager at CBM, and Reema Patel, who is a manager at our firm as well. And they will be speaking and responding to questions for an hour-long session. We are recording this session and slides will be available later on today. We will have a team member send them out to you. For those of you who submitted questions in advance, thank you so much. They have been shared with our presenters. For those of you who may have submitted questions, though, either this morning or late afternoon, we may not have gotten to them. So please feel free to use the chat box on your screen. And if we don't have the time over the next hour to get to your questions, feel free to follow up. We would ask as a courtesy to the presenters to please keep your video and your audio off. And with that, I'm going to turn this over to Jordan and Reema.
All right, thanks so much, Joe. I appreciate the wonderful introduction. I'm not sure if everyone can see Reema, but Reema and I have been working at CBM for quite some time. I'll go into a little bit of my background, specifically what I do for the benefit of our company. I do a lot of financial consulting. My background has been a lot of tax planning, financial planning. I do litigation consulting and forensic accounting work. So I have a lot of background, but a lot of what value I add to all our clients, staff members, and family, and external individuals from our firm is really helping them identify what sort of planning strategies they can come up with, not just for today, but tomorrow and the future. And I'll turn it over to Reema, and she'll tell you a little about what she does.
Hi, everyone. I'm Reema, as Jordan mentioned. So I am actually new to the financial planning arena. I am an accountant by trade first. I do audits of nonprofits and reviews of dealerships and some tax work as well. But I recently got into financial planning on my own because I started sort of woke up one day and realized I was several years into my career. I was starting to accumulate money and wealth, and I had no idea what I was doing. And we never really learned this stuff in school. And so I started researching a lot on my own, and it's kind of sparked this really strong interest in becoming a financial planner, because there's clearly a big divide in what information people have and need in order to be successful for themselves financially in the future. And so I'm currently studying to become a certified financial planner, and looking forward to getting more involved in that arena as well. Thank you. So with that, I think we can get started, right?
Sure. And Reema, we'll just let you kind of drive the car here and progress through the slides as we need to go through, so everyone can follow along. Is that okay?
Mm-hmm.
Okay, and so we'll ask everyone, if you do have questions, please try to add them to the chat over to the right of the screen inside the Teams meeting. We'll try to get through them if they're pretty quick, and we can answer them throughout our presentation. Otherwise, we ask that you hold them to the end, and we'll try to respond to everything, including those that you submitted prior. So with that being said, let's jump into some of our presentation. A lot of questions came in. Why is it important to know your net worth? Why do we need to figure out what it is? Why do we need to manage it? And a pretty interesting or funny story came to my mind that over the last year, we have a dog park near my house. And every morning, like clockwork, my 70-pound Bernedoodle wakes me up, begs to go to the dog park, and just runs out of the house every morning. And no failing. And so every time we go to the dog park, there's these two squirrels over there. And every morning, 7 o'clock,
Jordan, we may have lost you for a moment.
oh,
I think your audio. Jordan, are you with us?
Okay.
Yeah,
We
Reema,
might have
if you
lost them for a bit.
Yeah.
But Jordan, if you can still hear us, you can try turning your camera off. It might help with the Wi-Fi. Sorry about that, everybody. I'm looking forward to hearing this dog story because I don't know the story myself. But hopefully we get him back soon. So while we wait for him, I'll continue along. But the basic purpose of this presentation is basically we're going to go over some tools and tricks for you to be able to take this information with you and carry it on to enhance your own financial journey. And it's going to be pretty basic, so it's geared towards people who have no introduction or basic knowledge to begin with. Hopefully by the end of this presentation, you've got enough information that you can take control of your own financial future. So with that said, and Jordan, if you make it back, feel free to jump in. So we're going to first understand what is your net worth. So if you don't already know what this is, it's assets, your assets minus your liabilities equals your net worth. And a lot of people ask, why is this important? It's important for you to understand what your current snapshot is right now and how you can get that to grow in the future. Because in order to grow in the future, you have to really understand where you're at right now. So if you want to increase your net worth, how do you go about doing that? You either increase your assets or you decrease your liabilities. Your assets include, your bank accounts, your cash, your investment accounts. It can include your house, if you built equity into it, other types of properties. And your liabilities can include it's just your debt, your mortgage, your car loans, your credit card balances, student loans, things like that. The goal, like I mentioned, for increasing your net worth is to do so by changing one of the two variables, which is the assets and the liabilities. Is that you, Jordan? Did I hear Jordan? No. Okay. So moving on. This was something, we'll see if this will work. I know Jordan wanted to sort of get a gauge on what people in the audience thought the answers to these questions were. And I hope he makes it back in time to see this. But so if you guys can use a chat feature and just pop in what you think the average net worth is for Americans under the age of 35. That would be really cool to see.
Okay, hello?
Are you back?
I am back. I apologize,
Awesome.
everyone. So I think Reema went ahead for a few moments, and I think she kind of walked through a few of the items with you. So I'll just chime in real quick, and then we'll jump back into everything. Is that, the moral of the story of what I was saying is that I'm not sure how much everyone heard, but every morning I would see these squirrels stashing acorns, and one would work very hard. They'd be stashing 40, 50 acorns a day. The other one would stash just enough to, have enough for the day. And so I came back after 3 months of being in Florida to realize that one of the trees were flushed with acorns and the other wasn't. And these squirrels no longer went out and collected acorns because the trees weren't throwing them off anymore. And so what ended up happening is this squirrel was in a tree looking at me like he was a smug guy, that he was planning well, and he was sitting on top of the world from the accumulation of hard work of going out and accumulating the acorns. While the other one was nowhere to be found when I came back. It seemed like everything was gone. There's nothing left to be accumulated, nothing else to be collected. So he wanted to try, I guess. And then an interesting thing happened is, while I'm kind of going back to the dog park every morning, is I'm noticing these new trees sprouting underneath where the squirrel was stashing his acorns. So not only did the squirrel put in hard work and effort to accumulate and stash whatever he needed to, now he had the acorns actually working for him, creating even more for him down the line. So that ties into what we're talking about net worth and making sure that, we can kind of follow along with accumulating our assets and making sure that we're growing our assets over time as well. That way we're not left living day by day having to go seek out additional ones. So Reema, I think you spoke about why we're here today, what the importance is of knowing your net worth, correct?
Yes.
Okay. And we talked about specifically what is net worth. Reema touched upon the golden formula, your assets minus your liabilities, it's your net worth. So why do we really care about this over time? It's great to know the formula from a snapshot perspective to say, okay, I know I have $10,000 to my name, but that only gives us a snapshot in time. If we're not tracking it over time, which we'll talk about in a few moments, we really don't know how to adjust our direction or our directives in order to achieve the financial goals down the line. Okay? So Reema, did we talk about what the net worth is for individuals in our 30s and 40s?
No.
Okay.
I was hoping that we wouldn't do that before you got here because I know you like doing this.
Oh, this is my favorite. So we'll use the chat feature here. One of the things I found pretty interesting that came about from a study about a year and a half ago is what the actual average net worth of Americans under age 35 is, and then by 40. So we'll just do one exercise, but if you can type in a chat feature what you think the average net worth for age 35 is, I'm just interested to know what your thoughts are on it. $5. That's a good guess, Amanda. Samantha says 75,000. And do we have any other guesses? 100,000, 8,000, 25,000. So Reema, why don't you put up how much the average net worth is when you're 35?
Okay.
$6,676. So I don't know about you, but that was pretty mind-boggling to me.
Yeah.
And then the average net worth by the time you're 40, Reema, $35,000. And it kind of blew my mind at first that this is basically all our net worth is. But then I stopped to think about, okay, we have some houses, we have some large debt, maybe we have some cars that we purchased, that we financed. So give and take a little bit, I kind of understand where it's coming from. But also as part of the survey, what they found is that the largest single driver of what individuals in this age range thought was keeping their net worth from growing was a well-rounded financial understanding of how assets worked and how to increase value inside their assets and decrease liabilities. Okay? So at the end of the day, we want to focus on creating, generating, maintaining, and monitoring our assets or liabilities and how it increases. And this is for the 99% of us. If you're someone like an Elon Musk and you're in that 0.1%, or you're like someone like Drake that has $150 million of net worth, obviously the differential is huge and the formula becomes a little bit more skewed. But for the rest of us normal people, we obviously had to play by the formula and either front load the assets or we downplay the liabilities at the end of the day. So we had talked about tracking net worth just a second ago. It's really important that we keep, I would say, a pretty tight watch on this. And it's not something where we have to go inside our bank accounts and brokerage assets and go look at it every single day. But, over time, we need to see what the variances are. If we have a sudden drop in our net worth of $10,000, just as a round number, it could be that maybe our investment strategy isn't working as well as we originally thought it was. So if our plan was to retire 20 years from then, maybe that $10,000 drop has an insurmountable impact on that, and we need to adjust our direction. And one of my other cohorts at CBM, Alex Selesnev, that's in here, has a wonderful slide and a wonderful topic that we discuss in the seminar, which is about Alice in Wonderland. And it's a slide about, do you know where you're going? And the goal of tracking your net worth isn't just to say, okay, I'm increasing my value, I'm decreasing my liabilities, I have X dollars. It's really to establish your goals and figure out how you're going to go there. Otherwise, you turn into Alice in Wonderland and start weaving in and out of different directions and may not attain your financial goals. Okay.
All right, so now that you know how to calculate your net worth, we can dig a little bit deeper into how we go about growing it. This chart is really nice because, especially if you're starting out for the first time, you haven't really thought about this before, you don't really have a lot of, assets to your name. This is a good place to start because it helps prioritize how you should approach growing your net worth. So yeah, way back at the beginning, step 0 is budgeting, reducing expenses, and setting realistic goals. I think part of that is also like understanding yourself a bit more too goes a long way. So along with creating the budget and setting these goals, it helps to understand what kind of a spender, what kind of a saver you are, and what your relationship is with your money. Because if you do struggle with saving, then your approach may be a little bit different for how you tackle that than it might if you are really good at saving and want to figure out how you can spend it more effectively. You'll also see up here, step 1, building an emergency fund. That is pretty much high priority if you don't have any savings built up or if you're starting out for the first time. And I think Jordan will go into this a little bit more too, but just keep note of that. If you already have established an emergency fund, then you can move on to the next steps through this little hierarchy. But always important. A lot of people don't have enough saved to cover even 1 month's emergency if an expense were to come up unexpectedly, but that's why it's crucial, and we always sort of push towards that. So when it comes to budgeting and cash management, I know a lot of people hate the term budgeting or hate setting a budget because it requires so much work, but if this is all brand new to you, it's a really good place to start because it gives you some clear, concrete information about where your money is going. It shows you what money you're getting in, which, if you look at your paycheck, you can see what your net take-home pay is. But remember, in this example that we have here, if you're making $75,000 as a single person in DC, which is quite a bit of income, you don't actually get $75,000 to save and spend, and that's not really what you're getting in your hands. So after taxes, when you account for federal taxes, state taxes, Social Security, Medicare, and all your deductions, you may get about $52,000 or even less. So it's important that you consider that when you're doing, when you're preparing your budget and looking at your budget. But I think I'm hearing an echo, sorry, guys. But it's helpful to know what you're working with. And the other benefit of having a budget is you can see where your expenses are going. So there are certain costs that you can't avoid, like costs of living in your home, or like we said, taxes. But there are other costs that you get to spend however you like. And so if you're evaluating how your spending has been for the last 12 months and you're looking for ways to save, seeing those numbers can be really beneficial in figuring out, like, looking at your expenses as a whole, is it taking up too much of your net income, or can you move that around so that you can meet your retirement goals a bit faster or better? Some things to think about is if your rent is more than 30% of your take-home pay, that may be a little bit too high. You can consider looking to see if you can find a more affordable rent, or move back with your parents. That's always a good way to save money on rent. Just kidding, but that does work. I did that when I started, and that was really helpful for me. And some other things to think about when you're planning out your goals, how you're going to save your money and stuff. If you don't have the funds to purchase something, at least come up with a plan before you go about buying it. If you're going to incur debt, make sure that you've thought about what your needs are and what resources you have available and how you're going to pay it down. And we'll talk about debt a little bit too later on, but your goals should also be pretty smart. So I like the term smart because it helps sort of, we hear this all the time at work and also with your finances, but they should be specific and realistic. So you don't want to set a lofty goal that you're never going to be able to meet because it's just going to discourage you from ever trying again in the future. So having a budget helps you figure out what you have to work with. So you can set an actual number, a specific number that you know you can meet because you've done the research and the homework to figure out what that would be. So let's say you're starting off fresh and you're trying to build your emergency fund. If saving $200 a month for 12 months is too daunting, then take a look and maybe it's, cut it down to $50 a month for the next 6 months. And then once you achieve that, you do it all over again until you've established your emergency funds before you move on to your next goal. So it's all about kind of taking a moment to step back and look at the big picture and see where you're at and really understand yourself to really be able to set yourself up to succeed. Anything you want to add, Jordan, before we go to the next slide?
I completely agree with you, Reema. A lot of it deals with putting yourself first, making sure you understand what you have, what you don't have, what you want, and what you need. I mean, it's all part of the game plan, and it kind of comes into place when we're figuring out how we get to where we're going, like we were talking about earlier. It really is the cornerstone. And if it's a means of not being able to afford something, again, maybe you revisit your attack plan or you revisit your direction, like you're saying. So 100% on board with what we're talking about as far as the cornerstones to success and how to make sure we're manipulating that assets and liabilities formula to ensure net worth continues to increase.
Yep.
Okay, so we'll talk a little bit about saving and investing and just some general strategies. We did have some questions come in about what are some options for investing, what's available to me as far as brokerage accounts, retirement accounts go, and then just some general common mistakes and things to look out for when we're thinking about actually moving forward and implementing an investment policy for ourselves. So we won't go too far into really, should I have X% in equities, X% in fixed income bond? That's a whole other conversation that Alex Selesnev at our firm and the financial planning division of our firm can get into in another seminar. Our goal is really just to explain to you what options are available and how it impacts your net worth going forward. So this is another Q&A. So we'll go forward one slide, Reema. And I'm curious if anyone wants to guess what a cup of coffee a day over the course of 30 years would equate to. So let's say you go to Starbucks once a day, and instead of going to Starbucks now for 30 years, you put the $4 into an account. Anyone want to guess what that might be in 30 years, assuming it's invested? And feel free to put your answer in the chat function. I see no one has a guess yet. Well, so how long? So we're planning on 30 years. Let's say you just put $4 a day every day for 30 years into a regular investment account. So Adela says 45,000. Reema, how much would you guess?
Tom's
funny.
I would guess, I'm trying to be objective here because I already know the answer, but I would probably guess like, I don't know, 60,000.
Okay, so let's put the number up on the board. I think it's going to be shocking to a lot of people. So the actual number on a return, $114,000 in 30 years, assuming a conservative return of 6% on the money you invested. And it's just mind-blowing from being able to increase the asset side of the formula by just decreasing the consumption of 1 cup of coffee a day. And it's crazy. So let's talk about what it looks like maybe if you stop spending, or not stop spending, but what it looks like if you're going out once a day for a $20 dinner or $20 lunch. I won't give you the number because I'm even shocked by it. but I'm guilty of this. I like to go out. I like to eat lunch in Bethesda, or I like to eat lunch in downtown DC. And so $20, it happens quite regularly. It's quick to get up there. But what was shocking to me is if instead of putting that $20 towards food, and maybe I made my own food and brought lunch just as an option, that $20 invested over 30 years at 6% would return $570,000 just by foregoing that $20 expense each day. And I'm still trying to wrap my head around that, whether or not a sandwich is actually worth it each day, not worth it, etc., especially if we're going to Jetty's next to the office, Reema.
Yep.
So
Love that place.
the thing is, the reason I bring this up isn't just because it's an eye opener, which it is. It's also just to explain to everyone that, while saving is great, everything needs to be done in moderation. You should still plan to meet your goals from a financial perspective, but you need to balance out what you're saving. You have your mental health, your enjoyment, your hobbies. These are all variables that are outside the financial realm. We need to consider these in conjunction with our plans and our goals instead of strictly focusing on a dollar amount.
Right.
Okay.
And sometimes when you look at the dollar amounts, you do realize that maybe you are spending an excess amount of coffee and you don't even really like coffee that much, and it doesn't really give you value. So it helps to see what it looks like, because you're right, you want to spend it on the things that do give you some kind of satisfaction and benefit.
Sure. And it's funny enough, we talk about that. We'll move on in just a second, but we have a discussion, a topic at the backside of our presentation today that discusses job options and benefits and things like that. And it seems silly enough, but we've had people attend a seminar. It says, I actually consider the benefit of having free coffee at my office.
Yeah.
It has a dollar figure attached to it, a convenience figure attached to it. And it was just kind of funny hearing that there are all these non-tangible or fungible benefits that people honestly consider when they're thinking of new jobs or a new career.
Only if it's good coffee, though.
That's true. So let's keep going here. Reema touched on, where do we start? I just want to reiterate, it's extremely important that we start with an emergency fund. There are, of course, exceptions depending on what your financial plan looks like. But let's say we have our emergency fund saved up, which is generally, for me, I would hope 6 months is a good starting point. That can go up to a year, down to 3 months, depending on what your goals are, what your needs are, and risk exposure is. What's the risk that I have a $5,000 expense happening tomorrow versus a year from now? Okay. So once those funds are established, then we can start really thinking about, all right, where do we put our money after this? And what I always recommend is taking advantage of free money. I'm a big fan of free stuff. So the next step is to see if your employer has some sort of match contribution inside their retirement plan or some sort of profit sharing provision. So for example, if I match you dollar for dollar, if you contribute $2,000 to your 401k and my match works in such a way that I match $2,000, you just had an immediate return on your investment of 100%. There is nowhere else in the world that you can do that without risk. I mean, it's a phenomenal rate of return. So we always recommend to kind of explore that option first, and then start moving into additional options such as funding a regular IRA, traditional IRA, or a Roth IRA, and then kind of playing out how it works in conjunction with an investment account. Maybe you max out your IRA and then start putting into your investment account, or divvy it up 50-50. There's different ways and structures to approach it, and we can talk about that during Q&A. But the goal is just make sure you have enough asset base to prevent exposure to risk as much as possible. And risk, like we talked about, is the potential of not being able to cover an expense that comes up or a liability that comes up. Okay? So we had talked, there was actually a question about what sort of investment options are available. How do I get started? So these investment options exist any sort of place where your money can actually be put into what's called a broker or inside a financial institution. So this could be inside a retirement account, a 401k, a 403b, an IRA, even just a standard taxable brokerage account. Okay, so we're not talking again about what the structure is or how you should balance or invest, but just giving you a general idea of these assets that do exist that you can invest in. And so some of the assets that we usually see are mutual funds, exchange traded funds. And what these two funds do, or types of funds do, they're effectively an accumulation of different equities or different fixed incomes under one umbrella. So for example, there's a call sign IBW that does largely large cap stocks. And so in large cap stocks, you might have your Teslas, you might have your Walmarts, you might have Apples, Microsofts. And so a little piece of that gets put into each mutual fund and exchange traded funds. The real difference between the two is in mutual funds, you can trade them effectively once a day after markets close. You can't actively trade them. Exchange traded funds, you have more flexibility in being able to buy and sell them. So if there's a large dip or a large increase, you have the ability to sell them in real time. Okay. Individual stocks.
Sorry.
We're going to still talk about individual stocks for a moment. We generally, again, we're not talking about investment strategy, but generally individual stocks inherently have more risk. If you're investing in those on their own, just know that you're exposed to that company specifically increasing, decreasing, or having some sort of long-term growth or long-term decrease because you are invested specifically in that versus an ETF or mutual fund that has exposure to different assets under its holding. Okay, so there's other things that we can talk about. They're way outside of this, and they're kind of more of an advanced strategy. Private equities, real estate investment, physical assets such as gold and precious metals. We can talk about those at another time, but just know they exist. It's not something that we really want to approach, though, as we're starting off generating our net worth. Generally, we recommend just kind of sticking to a plan and investing in broad market sort of options. Okay, so now that we know some of the assets that exist, what sort of disciplines do we need to keep in mind? Well, if we're just starting off, keep everything simple. Simple and automatic is the best way to approach it, at least for the first year or two when you're first understanding how all the different pieces fit together in your investment policy or inside your net worth strategy of going forward. By automatically investing, you don't have to go into a brokerage account or a financial institution and manually purchase these things. It becomes a little bit of an overload situation where you're just starting out. You know, is now the right time? Do I have enough? Did I pay myself first? There's all these questions that come up. If you pay yourself first and automatically invest and automatically deposit, all of those questions and stress kind of go the wayward. And the thing to take away too is when we're talking about automatic investments and investing, we're not talking about basically works in equities and fixed income, and it gets more conservative as you approach a certain date. So for a 2050 target date fund, as we get closer to 2050, instead of being in risky investments, it starts going more towards less risky investments. Do you want to invest in this? This is up to you. Again, we're not talking investment policy here, but just know that these funds are basically meant to invest in if that's all you're holding and that's your strategy. It doesn't really consider any sort of outside holdings if you have other ETFs or you have other mutual funds or stocks. All right. I always like to think what a good way of thinking what your money might look like down the line from now is the rule of 72. And the rule of 72 basically says, hey, if we take the rate of return we're expecting over the next however many years, and we divide it, and we take 72 and divide the interest rate by that, that's how long it takes for our money to double. So if we have, for example, approximately an 8% rate of return that we're expecting on our money, and we divide that into 72, it comes out to somewhere around 10 years or so that we would expect our money to double. So it's kind of a quick and dirty way for you to test whether or not you're on course to attain your financial goals, just from a high level. Of course, you can dial down and you can drill down a little bit further to figure out, if you need to adjust that formula or if you actually need to get into the minute details, but it's a good starting point. Okay.
Jordan, since we're talking about time horizon and savings, do you want to address one of the questions about whether the same thought process applies if you're a mid-career professional but just starting out with savings?
Sure. Let's come back to that at the end if you don't mind, because that's kind of a big glass to drink out of, and I want to make sure we cover everything we have. So the goal too is when we're talking about this slide's perfect, but the goal here too. Oh, is there an issue with the connection?
I'm hearing you fine.
Okay, so the takeaway too from the discipline and time perspective. Okay, thank you everyone for chiming in and appreciate it. Is that as we basically go through time and approach kind of a more mid-career strategy, again, we'll talk about that later, is that the importance of just increasing your financial knowledge and your investment education is insurmountable. The smarter or more intellectual you become or more well-versed you become in your own money, the easier it is to manipulate that net worth formula. It's easier to add cash, add savings, add investment returns versus incur liabilities and drag down your net worth formula. So just keep in mind, you always want to be like a sponge and sucking up knowledge from the financial side of things. A lot of common mistakes that we've been seeing or hearing, and questions that you asked, are really only experts can perform well. Investing's for the rich. Investing is difficult. It can be if you make it that way. We always like to take a keep it simple policy. I take the approach, and I think Reema's on board, and really, a lot of people in the financial community, where it's simpler. Oh, yes. The simpler you keep it, the easier it is just to kind of, make sure you're achieving your goals. It's not only experts that can do it. By doing regular investments and regular paying yourself first, it's quite easy just to kind of put it on autopilot and then, take it from there. A big question is, what happens? I'm trying to time the market. If it goes down, I want to put money in. If it goes up, I want to sell. I can tell you from personal experience, and also speaking with a lot of our financial planning clients and clients in other areas of our firm, is that timing never works. You're always chasing a perfect moment. It's never there. You can't have a crystal ball and see what happens. You can only see what happened in the past. So the way to kind of curb the risk of timing the market, you're effectively just regularly depositing funds. Right? You're just regularly making deposits and investments and effectively setting it on autopilot. Okay, so we'll talk about some of the more common mistakes at the end too. I know there's a couple more questions. The thing we want to keep in mind, that even though we're taking an investment standpoint and trying to increase our assets via brokerage accounts or retirement accounts or otherwise, is that we still need to consider our short-term, our mid-term, and our long-term needs. When we're talking about, trying to grow our assets by having some sort of investment, and not just strictly depositing cash or savings from our earnings or our income, we kind of have some exposure to risk at any level of it. And the gist of it is that as we get more risky with our investments or our contributions to our accounts, the liquidity we have available to us starts decreasing at a rapid pace. Why do we need to know about this? Why is it important? Well, I'll give you an example in a moment, but we need to make sure that if we have a short-term need, which is something, let's call it a year, or mid-term need, something within 2 or 3 years, that we have the ability to meet that need. And we don't have the risk of all those assets and all that cash decreasing suddenly when we need those funds. So it could be a home purchase, a vehicle purchase, could be some sort of education, etc. Okay, so we just want to make sure that You know, if it's cash, we're making sure that it's fully liquid. If it's a money market, it's still liquid. But if we have a short-term need within a year, maybe we don't want to park our funds in a retirement account or an investment account where it's subject to risk and not really accessible. Okay, so I'll give you a real-life example. This, I'm hoping everyone can make the slide out. I know it's a little bit small, but this is a perfect example of what happens when you want to make what happens for the risk versus liquidity side of the equation when you're planning to purchase a house. So let's say you have a $500,000 house you want to purchase and you want to put 20% down, right? You would need $100,000 and your goal is to meet that in 5 years. If you were planning to meet that just by depositing your funds into some sort of cash or money market account that return, let's just call it 0% for ease of calculation, you would need to come up with somewhere around $1,700 a month, right? Whereas in equities or market, everything looks great over time because we say, okay, well, we know that over time, the market is generally returned 7 to 8% conservatively if we have everything invested. That's an excellent way to approach it. However, that smooths that return out over time. So the risk we run into is that all of a sudden we have this huge drop come year 5, and now we just lost 10, 15, 20, 50% of the funds that we were saving towards the purchase of our house and our down payment. Whereas now that we had the cash saved away, we are able to go ahead and meet our plan of purchasing the house in 5 years. So it's not a perfect science as to how risky or how not risky you want to be. But if your goal is short-term, mid-term, just keep in mind the liquidity and the risk situations of both sides of the equation when you're trying to approach your goal. Okay, Reema, on to you.
All right. So I'm hearing an echo. I hope not everyone else is. But so with you learned a little bit about the assets and increasing your assets. One of the things you can also do, again, like we mentioned in the beginning with growing your net worth, is to also manage your liabilities. And what's really important with managing your debt is not that you necessarily have to eliminate all of your debt to be, to grow your net worth. What's important is to distinguish between what is actually a useful and good debt, which is going towards acquiring something for your future self, like a house, and what is bad debt, which is really doing nothing for you except just increasing your liabilities, increasing your interest and fees and things like that. So with student loans, we can't go too much into detail here because it's another area that could go on forever too, but just really, really understand what the terms are for the loans that you have. Be aware that there are tools that can help you manage how you pay them off, such as, you can consider like forbearance and loan relief and things like that. And I think one of the key things right now is the payments are currently being deferred or allowed to be deferred. So if that applies to you, it's something definitely to take advantage of. And then with non-student loan debt, consumer debt, which is also not non-mortgage related debt, this primarily applies to credit cards. So if you have, let's say, multiple credit card balances that you're trying to manage how to pay off, it takes up a big chunk of your debt and you're struggling to figure out how to pay it off. There's 2 different methods that could be helpful here when it comes to approaching this debt. So with snowball effect, with both methods, snowball effect and avalanche effect, you have to pay off all the minimums on all your loans because you don't want to expose yourself to that additional risk, like we talked about earlier, try to reduce your risk. If you're not paying minimum balances, you're subjecting yourself to a lot more penalties and interest. But with the snowball effect, while still paying all the minimums, you focus on the smallest balance. And this is helpful for if you find yourself more motivated by those quick wins. So you accomplish, paying off the one small debt, then you move on to the next small debt and the next small debt. And if that motivates you, this could be a good option for you to consider. It may take longer, but it is a little bit easier. And like I said, it gives you that satisfaction a bit earlier and more frequently. Versus the avalanche method, you start off with the highest interest or highest balance debt first, and because it's your highest balance, it can take a lot longer to finish off that first loan. And so it can get discouraging. If you're not motivated by that, it may not be the best option for you. It is a little bit harder, but you can end up saving a lot more in interest costs and reduce the time that you're paying overall. With credit cards, if you are considering, financing a purchase on credit card, make sure, like we talked about earlier, that you have a plan in place for being able to pay it off. And if you are going to open up a credit card, there's absolutely no reason that you wouldn't get some kind of benefit out of it, because nowadays all the credit cards have some kind of perks. And I think PointsGuy.com and NerdWallet both do a pretty good job of evaluating credit card offers every now and then. So it's good to take a look at that, especially if it's your first time opening up a credit card. Right. And on that note, it's also helpful to have a credit card if you're going to be using it wisely and paying off your debts, because it can really increase your credit score. And while most banks and credit cards give you your credit score pretty regularly now, it's really easily accessible. I also strongly encourage everyone to take a look at their full credit reports. And we have the link on our resources page at the end, annualcreditreport.com or something like that. You can get a credit report from each of the 3 agencies every 12 months. So very important. Take a look at that. It helps get you some information as to what's going on with your accounts. It can help you spot any unusual activity or fraudulent activity that's happening under your name. And it can also help you see which accounts are dragging your score down and why. If you're delinquent on your payments, it can stay on your credit report for, I think, like 7 years or so. And that can also, it's something to think about if you are, having trouble making those payments. Before I move on, anything you wanted to add, Jordan?
No, I think, again, you hit everything on the head. I think the takeaway is, don't be afraid of debt. I mean, yes. Debt's kind of like this understood dirty word, so to speak. But, if it's something that you need or you want or you have and you have the prowess to pay for and it fits in your plan, go for it. We just don't suggest over leveraging yourself to the point where now you have more in a liability scale than an asset scale. Then it becomes a lot harder to dig out of that liability side. It's real easy to add into that liability bucket versus the asset bucket. Someone asked, sorry, I'll get to Divya's question in a second, but it's real easy to tack onto the liability side and weigh yourself down, and it is the asset side. So just be cognizant of that when you are using consumer debt, credit cards, auto loans, etc. All right. Divya asked, does it impact your credit score to pull your credit report annually using that website? Generally, the answer is no. I've never seen an impact. And it's my understanding that all the free annual credit reports, especially the government-sponsored one, is really just pulling the report itself. It's not as if a creditor is accessing your credit report. Okay. So let's jump into. We had so many questions on rent versus buy. So I'm going to touch upon this. I could have a 5-hour conversation with anyone about this. Reema, we'll talk about this for a minute or two and then jump into a couple other topics before we get into Q&A. But Reema's currently renting. I just went through this specific analysis and purchased my house a year and a half ago. So I'm well versed in all the ins and outs. But the general idea at the 1,000-foot view is that you want to stay renting if you want flexibility. If you don't want the headache of having to replace things when they break. If you're not planning to live somewhere longer than 4 or 5 years, which is kind of the golden rule of where your break even is supposed to be, given the closing costs and transactional costs of owning a house, right? So that's the 1,000-foot view. On a buy side, you would want to see what it looks like. Am I planning to stay somewhere longer than 4 or 5 years? Do I like home ownership, doing projects? Do I like having the ability to lock into a fixed amount of mortgage for perpetuity of the loan. Whereas rent can increase with inflation, or in DC, it could go from $2,000 from a one bedroom to $3,000 for a one bedroom. So it's all those things that you need to consider of what kind of fits with your plan to reach your goal over, the time spent developing your net worth. One of the questions that are asked of me personally is, well, why is there this 4 or 5 year rule? And I started scratching my head. I go, well, in a regular appreciating economy, there's a 2 to 3% appreciation on real estate, generally speaking. But why are we assuming that I'm moving after 5 years? The question kind of then becomes, well, what's your plan after 5 years? Do you plan to move out of the house and then maybe turn it into a rental and give yourself basically an income stream for however long you keep the house? That kind of puts another perspective in how you approach the rent versus buy sort of scenario. So keep that in mind. It's also a little bit of a different topic depending on where you're living. If you're considering buying something in DC versus buying something out in Minnesota, there's a much different, I would say, trade-off between owning a house and sort of a return on asset perspective of putting the funds in some sort of investment portfolio versus just putting them towards rent. Okay? So we'll go into some tips. We talked about those earlier. Avoid leveraging or over leveraging yourself. Be wary of accumulating debt. And look into refinancing your debt or consolidating everything. Right now, interest rates are incredibly low. So it makes sense to even kind of explore the option. What's it look like if I move my balances to this credit card? What's it look like if I refinance my student debt from 6% to 2%? And I think you guys will be blown away with the savings that you will incur over the course of even just a year or two if you're paying off monthly. Okay? So we got 2 more topics today, and then we'll do some Q&A. We put this topic in here just as kind of a little wet your whistle sort of topic, and it's really just protecting yourself. You, yourself, and your family are your greatest assets. And so when we talk about protecting yourself, we're really talking at a high level about insurance needs. Just know that there's all sorts of different types of insurance: medical, dental, short-term, etc. But if you're making sure that you're implementing this as part of your financial strategy to protect yourself and protect your assets, know that this is a needs-based approach. So for example, from a life insurance perspective, as you're starting off in your career, let's say you have a wife and you have 2 kids, or you have a husband and you have 2 kids, and they're relying on you to bring income in to support the family. You may need a higher life insurance policy to supplement the loss of your income in case of death. Whereas as you grow older, let's say you're in your 40s, 50s, 60s, that need goes down as your assets increase. So you kind of have to think about where you're at, where you're going, and what your needs are to kind of make sure everything fits into place. So we'll go forward on that end.
And also with short-term disability, there's a waiting period, right, before it kicks in. So I think you brings back the focus of making sure you have emergency funds available to cover that gap in case that ever happens to you.
Exactly. And real quick, the reason we have long-term disability underlined, it's really an excellent policy and plan to have in case you can no longer work, but you're still living. Depending on when you get your policy, it could be fairly cheap. I know I have a long-term disability. I started 8 years ago, and it's $20 a month for maximum coverage in case something actually happens. So look into it, but it's basically some way to bridge the gap of not having income in case that happens. Sometimes your employers offer it. If you're working for the government, they might offer it. But we can talk about that in another time, or if you have questions, you can ask us by email. Okay? The other thing to keep in mind, just from a protecting yourself perspective, is really consideration for estate planning. I know when everyone hears estate, we think, okay, you have to be in your 70s or 80s to really start considering this. But the takeaway I want to give to everyone, and the seeds I want to plant, are really just to understand what happens if you don't have any planning. If you don't have a medical directive, for example, there's no one that's assigned to make medical decisions for you in case you're not able to do so for yourself. in case you don't have the aptitude to make financial decisions any longer and you're incapacitated. Who makes financial decisions? So that's a good question. We'll get to that in a second. Thank you. So what happens upon someone's death if they don't have any sort of directives in place? Well, effectively, let's say you have $100,000 of assets. Now the state kind of comes in and says, now we're directing where those assets go and how they're divvied up. So you kind of leave everything for other people to decide for you if you don't have these things put into place. So at a minimum, you should really be thinking about your healthcare directive, what happens to your assets as you start accumulating them, and really just think of a plan of how you want to structure that and how you see things happening in case of an, lack of a better term, unfortunate, untimely demise. Okay. So we got two more topics. This is my favorite one. We're talking about some tax planning and why there's an advantage to it. I like to kind of think of the great proverb in the Bible. It goes something like, the economy giveth and the IRS taketh away. And so from my perspective, I like to keep as much off the table in taxes as possible. And it's a way that we can easily increase our net worth by adding to our assets and reducing down the liabilities to the government. Okay? So just some things to keep in mind. April 15th, that's your time to pay your liability. You can extend your income tax return until October 15th. It's not an extension of time to pay. It's an extension of time to file. A lot of people get caught up in that and then get surprised by penalties. The other thing to keep in mind is that there's a free filing utility through the IRS if you make less than $66,000 of income. It's also available through various entities like Intuit, etc. Something to keep in mind so you all are not shocked next year when you file your taxes. The stimulus money that you received, if you did, is an advanced tax credit, meaning you will see a line item on your 2020 tax return that says, okay, $1,200 tax credit, and then you will see a reduction of that tax credit for the money you received. So just keep that in mind. You're not getting a double dip when your taxes come, and you shouldn't be shocked when you're not getting the credit. All right? Let's talk about some planning opportunities, and then we'll start wrapping everything up. So these are excellent planning opportunities. A lot of clients and a lot of individuals in their 20s and 30s aren't really aware of some of these, right? And my favorite is really having an H.S.A. contribution. So let's say you have an H.S.A. health savings account plan available to you at work and you haven't funded it because you can't, it hasn't really made sense. But let's say, for example, you have a dental bill that's $1,500 for a root canal. You can fund your H.S.A. for $1,500, pull that $1,500 back and reimburse yourself for that expense, and then take a tax deduction for that. So it's great just by doing an in and out sort of transaction. We have a question, what's the difference between an HSA and an FSA? The flex savings account is an account which you put X dollars into. So let's say $1,000. If you don't use that $1,000 by the end of the year, it's gone. The health savings account, on the other hand, you can put that $1,000 in and roll it into perpetuity until you can reimburse yourself for expenses you incurred or for expenses you're incurred. Okay? I'll touch on 2 or 3 other ones that are really cool. The student loan debt relief tax credit in Maryland. I don't know how many people are from Maryland here, but basically if you've incurred over $20,000 of student loan debt and you have over $5,000 of balance currently, I believe those numbers are still accurate. I haven't checked the update. They'll give you a tax credit on your state taxes just by applying for the tax credit. And it is crazy. There's no other benefit you receive from a state like this. Basically, you have a student loan, they'll give you a credit for having a balance. So we can talk about that more in depth, but it's a great thing to keep in mind. Also, kind of at the forefront, next year, 2020 taxes, when they come due, your charitable contributions, you get a freebie, which moves from your itemized deductions, which if you're not itemizing, you have no benefit. It moves your charitable contribution of $300 above the line, so you get the benefit now. So everyone gets it as long as they contribute. It's great. So consider that kind of towards the end of the year and think of that for tax planning purposes, whether or not to make the contribution. We won't talk about too much of Roth versus traditional. That's a 5, 6, 7 hour topic, seminar discussion. Feel free to shoot me your questions on that. I always love talking shop on those. So really kind of the last topic we have is taking control of your career. So Reema will touch base on that, and then we'll take some Q&A.
All right. So real quick to wrap this up, when you're considering different job offers, it's important to think about, it's really easy to just pick the job that pays you the higher salary, right? That seems like the easy choice in growing your net worth. But there's actually a lot more that goes into that consideration than just who's paying you more. For example, you could have a job that's paying you, $25,000 more than another job offer, but are they also providing an employer match to your retirement plan? Are they subsidizing health insurance? These are all things that matter, and as we talked about through different aspects of this presentation, are ways that you can impact your net worth. So if you're taking a lower salary, but they're offering all these other benefits, you want to consider that it could rank that job a little bit higher. This job offer comparison is a good place to start if you're looking at it. It has not only just the financial attributes to considering a job offer, but also some non-financial attributes too. So like we talked about earlier, maybe having that free coffee at work is a really good perk for you. Maybe taking a higher salary job means it adds an additional hour of commute each way. Are you willing to sacrifice your time for that extra money? How does that play out in your considerations? Are you compatible with the firm's culture, right? Like that plays a big role too in creating a happy work environment and being engaged in your work. Right. And these are all important because the way that you approach how you want to take your, how you want to advance your career also plays into how you brand yourself and how you market yourself. So what are the skills that you also have to offer, and how can you use that when you're negotiating some of these packages? Sure. We'll have this in the hand. Sorry, go ahead.
All right, and Reema, just one thing I also want to add too is, having all the benefits in the world and having an increase in salary and having all of these things, it might look great today. What does that look like 5, 10 years from now? Are you entering a career? Are you entering a job where you basically set and that's it? There's no advancement. There's no places to go after that. You have to figure out what's important for you. Is it important to continue career progression? Is it important just to stash as much money away as possible? It's funny because I was watching a show that recently came out on Netflix, which is Cobra Kai. Hope everyone's watching. It's a great show. And the premise is that Danny LaRusso is talking about balance, and everything needs to be balanced. If we're focusing strictly on financial side of things, we're losing out on the ability to have enjoyment and the ability to have fulfillment. So we need to kind of balance that out while obviously keeping track of how this impacts us for our financial goals into the future. Okay. So we have a handout that we're giving to everyone. It also includes analyzing job options and analyzing some of the caveats that come with it. So it's that specific slide and topic plus a couple other Q&As that you can ask yourself for whether or not something's the right fit. The one takeaway I'll leave everyone with on that slide, which Reema and I talked about quite a bit, is that don't chase the dangling carrot at the end of the day, meaning don't just chase the money. And then also, if you're trying to really continue on in your career and grow your career, which is one of the questions we were asked, how do I establish my career? How do I grow it? You need to ask yourself, what value do you provide to your company, to yourself, to the government, if it's a government entity you want to work for, etc. Once you can answer that question, you can start leveraging yourself and figuring out, okay, I know I can provide this value, so I want to expect X, Y, and Z. Okay? Very funny, Romana. She watches the show as well. So Reema, thank you so much for talking about the job comparisons. I think it's really meaningful, especially now given all the COVID issues and some people not having jobs and restructuring how they're going about into the future. So like Reema mentioned, we have some great resources. I highly recommend everyone poke around on these. NerdWallet's great. I like Doctor of Credit if you're really trying to kind of figure out how to arbitrage savings and asset accumulation positions. So like I said, or mentioned earlier, something my father always instilled in me is money isn't everything, but it sure does help. And that's kind of the takeaway from here. Make sure you're focusing on meeting your goals through accumulation of assets, through decreasing liabilities, but make sure you're having fun doing it. Make sure you're pursuing your hobbies and passions, and you have fulfillment along the way of your financial career. So with that being said, we have a couple seminars coming up. We're leaving them on the slide for you. They're also going to be in a package that we distribute to everyone. And that's basically what we have for you. I know there's quite a few questions. Feel free to stay on. We'll try to answer some of them in the chat, and then we'll try to answer a few of them that were asked earlier on. So I'm going to work backwards here. So John was asking, given an environment of low rates, what would you recommend doing with excess savings if you are already contributing a substantial amount to retirement in cash? So without going too far into investment strategy or advisory, something for me, if it's a short-term or mid-term sort of viewpoint that we're trying to look at, it might make sense just to park the funds in some sort of like money market or cash account. And I know that sounds a little wonky. Hey, I'm not getting the return that I could get elsewhere, but there are credit unions, there are banks, there are other institutions that are paying upwards of 2, 3, even 4% still just on high yield checking and savings account. So if you go to Doctor of Credit, they have a list of those banks that you can park your cash in. And you're not going to get rich off of it, obviously, but it's a nice way to hedge inflation by having that small return come in through those high yield accounts. Okay, talked about that. One of the other ones I wanted to discuss as well was, does it make sense to buy something now with 5% down or 10% down, or wait for 20% down? It depends on what, A, can you afford the payment for what you're putting down? B, from a financial perspective, if you're really thinking of, what the markets will look like down a year, I mean, again, no one has a crystal ball. If you wait to get 20% down, maybe the real estate increases by 40% by then, or maybe it decreases by 40% by then. What I can leave you with a good nugget of information is, even if you don't have that golden 20% down, there's 500 different ways to structure financing and purchasing a property, even with 3.5% down, 5% down, etc. Especially if you're a first-time home buyer. The creditors love that, and they have all sorts of programs available for you. So keep that in mind, is that if it fits your lifestyle and it fits your goals and you can afford to pay for it, maybe it makes sense to buy it now with less down. And that's what I did personally. I put 10% down on my house, paid a little bit of PMI for a couple months, and then we refinanced after the house appreciated and knocked the PMI out, and we kind of hedged appreciation of real estate markets. So, kind of one way to look at it. Let's see what else we have. Okay. And then, Reema, did you want to bring up one or two of the questions that were asked of us beforehand?
Yeah, let me go through them.
And after these one or two questions, everyone, we're going to try to wrap up here, but we'll leave you with our contact information on the last slide. And absolutely feel free to send Reema, myself, anyone at the firm, any questions that you have. We're always happy to assist everyone as best we can. And if it's above and beyond and it's a more technical topic, we can help you out in that as well. So feel free to ask about that too. Okay, Reema, I'll let you pick and choose two of the questions.
So I think we didn't cover, I don't think we covered this one, the 529, when you should start saving for a 529 plan. We didn't talk about that yet, right?
No. Okay. Yeah. So let's talk about that. That's kind of a biggie. So we'll just take this one question. When should you save for a 529 plan, or when's the right time? There's never the right time. The right time is now versus later. If that's part of your plan, is to, have college paid for or subsidized for your child or for someone else. You want the value of compounding interest and compounding growth over time. Okay. So if you're putting $1,000 in today and your kid's going to college tomorrow, chances are you're not getting the benefit of those funds. So just know, the earlier on you invest it, the longer time you have for it to appreciate. The one thing I'll mention as well that I don't think a lot of people ask is, okay, there are 529 plans. Which one should I invest in? And everyone thinks that if you're in Florida, you need a Florida 529. If you're in DC, you need a DC 529, etc. It's not really the case. Generally, if you're looking at a 529 plan, you want to make sure you're understanding what the fees are, what the investment policies are, what the general performance are of the funds that are held inside that 529. So they're all not created equal, right? So the great thing, though, about being in a DMV area is that our 529 plans for DC, Maryland, Virginia, they're pretty good. And if you do make a contribution into those 529 plans, they're generally tax deductible on the state side. So if you put $1,000 in and your state tax rate is 8%, you basically get an $80 tax deduction. I'm sorry, you basically get an $80 reduction in your taxes. So it's a really nice deal if you're living in a state and using a state-sponsored plan. But the tax asset that you're generating shouldn't drive your decision of where to grab the 529 and enroll in the 529 plan from. Okay, so I'll leave you with that. So are there any other last minute questions? If maybe it'll take a quick 5 or 10 second answer, we're happy to respond to them. We're out of time in getting into the big ones. Okay, we actually have two. Mortgage at 4.5% is a good time to refinance. I had about 3 or 4 questions on this. More specifically, I want to refinance, but I don't have the cash, or I don't have the money, or don't want to bring the money to close. What can I do? 10 different ways to skin a cat here, right? One of the ways you can structure it is, instead of getting a 2.5% rate on a 30-year mortgage, for example, maybe you go to 2.625% rate, and then what happens is, as you increase the rate from the lowest rate possible, you'll start getting credits from the lender at closing that can offset the closing costs. So by doing so, you can effectively walk away from a refinance from 4.5% down to 2.5% without anything out of pocket. And it seems like a pretty sweet deal to me. There's obviously other considerations that go into whether or not you're refinancing, but if you're specifically rate driven and you're specifically driven by paying less each month, then it might make sense to. You know, if you're a year left on your mortgage and you say, well, do I want to refinance into a 30-year mortgage? You know, a little bit of a different story than if you're kind of, 1 year into your mortgage and you're thinking about refinancing. So happy to discuss that more ad nauseum. There's all sorts of different accoutrements to think about. But generally, in lower rate environments, it always makes sense to at least explore the option of refinancing or restructuring your debt. So Jonathan asks, and this is the last question, Jonathan asks, is it critical to time the market for lowest price, or best to invest as soon as possible? I personally, and I think generally, the best approach is not to time the market. We've seen various studies that have been published and read articles and all sorts of different analysis that, even if you invested in 2009 at the crux, or 2008 at the crux of the last financial chaotic time we had, as long as you were regularly investing, you did better than trying to time the market at the top with one investment. So generally, regularly investing, generally paying yourself first, and just kind of making those contributions over time hedges the risk of having, a huge loss or a huge gain. I think that's more the conservative way to approach it. And that's when you see and you hear when people are talking about, oh, there's an average 8 to 9%, 7%, 10% rate of return on assets. That's over the long term. If you start looking at individual years and you start trying to time the market, it could be that you're losing 50% or gaining 100%. So the longer term approach is the better approach from a net worth perspective if you're trying to accomplish specific goals. Okay. And I think that's all the time we have today, everyone. So Reema, thank you. Joe, thank you as well. I appreciate everyone that attended today, for those that are still here. And again, our contact information is on the next slide. Feel free to email Reema, myself. Our numbers are on there. Our emails are on there. And we're, again, more than happy to help you out going forward, okay? All right, everyone. Thank you again for attending, and we look forward to speaking with you hopefully in the future.
Thanks, everyone.